In the stock market, one of the things that you hear over and over and over is the PE ratio. The PE ratio is a super useful metric that allows you to get an idea of whether or not a potential stock is undervalued or overvalued. In this video, I'm gonna share with you everything that you do need to know about the PE ratio. And if you stay until the end of the video, I'm gonna share with you how it is that automatically you can get the PE ratio for thousands of companies in one go on your Excel and Google Sheets spreadsheet. Okay, so the PE ratio is a very commonly used metric when it comes to analyzing stocks, and the reason why is because it's quite a powerful metric if you know how to use it and you know its limitations. So the first thing that you do need to understand is how the PE ratio is calculated. Once you understand this, then we'll get into how it is that you can calculate it step by step with an example, and most importantly, why this metric matters. So as you can see in this graphic, the way to calculate the PE ratio is very simple. All you need to do is to take the current price per share of a particular stock, and then you divide that by the earnings per share of that particular stock. We have a video that talks about how it is that you can calculate the earnings per share for a particular stock, but the way to do it is super simple. You basically take the net income of that particular company, aka the profit, and then you divide it by the number of shares outstanding of that company. That's gonna give you the earnings per share. And then the share price, this is something that you can easily Google, but I'll also share with you how it is that you can get this automatically on your spreadsheet. So the PE ratio can be calculated based on different earnings per share. Usually the way that it is calculated is by taking the earnings per share of the last 12 months or the last year of data reported by the company. In this case, I'm going to show you the most common way to calculate it, which is the last 12 months or the trailing 12 months. So let's get into that. The first thing that you're going to need is to get the company's earnings per share. You can Google this, or in this case, I'm going to share with you a good way of getting this information. So let's calculate it for a very known company, which is Apple. In this case, we're going to select quarterly data and then click on get data. And by the way, we're using the Y Sheets add-on for Excel and Google Sheets to get this data right here. We're going to get the key metrics, cash flow, balance sheet, income statement for many different years. In this case, to us, what matters is to be able to calculate the trailing 12 months of the EPS. So right away, if you zoom in, you'll see right here on the income statement of the company, we have the EPS. So I'm just going to bold it so that way you could see it, and it's right here, and this is on a quarterly basis, so you can see the quarters and you can also see the dates at which the company reports and the respective financial results. So to get the EPS for the last 12 months, what we're gonna do is very simple. We just take the sum of the EPS of the last 4 quarters. So this is the EPS that we're gonna use in the PE ratio equation. And now the last thing that we need to get is Apple's current stock price. Now to get the stock price, this is very simple. We're gonna again leverage the Y Sheets add-on for Excel and Google Sheets. So we're gonna use this custom function that's gonna ask us for the symbol. In this case, it's gonna be Apple, and then it's gonna ask us for a parameter. So we're looking for price, and this is gonna give us the real-time price of Apple at this particular time, which by the way, the markets are open, so you'll see that it can constantly change. So once you click here, the stock price is going to load and it's going to show right here. So now we can easily calculate the PE ratio of the company. So if you remember, equals the stock price divided by the EPS. So we already have the stock price. We divided by the EPS. And in this case, this is going to give us the PE ratio right away. Once you know how it is that you can calculate the PE ratio of a particular company, the most important question is, what does the PE ratio tell you about a particular company? So in this case, we know that the PE ratio for Apple is 32. What does this mean? This basically means that for Apple, this is the EPS, so the net income per share essentially. And with this number, we can infer that right now, if we were to purchase Apple at this particular price, we would be paying 32 times the earnings per share of the particular company. So 32 times, that's quite a high number. And usually the way that the PE ratio is interpreted is that companies that have a higher PE ratio are more expensive, aka more likely to be overvalued, and companies that have a lower PE ratio, they tend to be more likely to be undervalued by the market. Now, one thing that is really critical to know, and I really want to emphasize this, is that companies that are higher quality usually have a higher PE ratio, and that's because there's less risk involved in investing with those companies. Companies that have very low PE ratios, like for example 3, 2, 1 even, or like 5, they tend to be more risky companies, and this is why they trade at a lower PE ratio multiple. Another way to be able to visualize what this number means is by creating a table like this. So in this case, we have different years and we have the EPS. Now let's say that the EPS for Apple remains steady and it doesn't grow, it doesn't shrink year after year. If we do this calculation where we take on year 1 the current EPS, year 2 we take the EPS plus the new EPS, so you can see the formula right here, and we apply this formula for all these many different years, you will see that in roughly 32 years, this is where we will approximate the price or be able to make a return on the particular company. So that's another way to think about it. As a bonus, I want to share with you how it is that you can build custom screeners, and that basically means being able to analyze a whole bunch of companies, so you can literally have thousands of companies on this list right here. In this case, we have a whole bunch of companies in the semiconductor space, and we're gonna use this mini screener to be able to spot potentially undervalued companies. So we have the stock list, we have these metrics that we want to get, and the cool thing about this is that all this information right here will be automatically populated for us. So the way that you do that is you simply select the list of tickers that you want to get data for, click right here on this Y screener function that we have on Y sheets, then select the parameters that we're looking for. So in this case, the EPS, the price, and the PE ratio. Click here, and now we can see the range, and then click on get data, and what you see is that automatically everything populated. And because this changes all the time, because like the price is constantly changing, you can just click right here on refresh live data, and you will see how automatically the data will also update for you. And now if you have a table set up like this, the cool thing is that you can start to see which companies, for example, have lower PE ratios and investigate those companies because they could be undervalued. So in this case, we can see this is one of them. Another one that looks interesting is this one right here. And you can kind of go through the list and see the ones that have attractive PE multiples. Now, obviously, this is not an entire way to find undervalued stocks. In fact, what I recommend is that you get a lot more different metrics such as price to sales, fundamental metrics, and many other key metrics like return on invested capital. You can easily add them here, change the range, get the data, and that way you can create a stock list like this, and then perhaps add some filters, so that way you can sort, for example, and say show me the companies that have the lowest PE ratios first, so that way we can see them like this, and you get the idea. Now you know all the most important things that you do need to know about the PE ratio. So go ahead and use this knowledge so that you can make good investment decisions for yourself and for those people that you most care about. If you've enjoyed this video, make sure to subscribe and turn on the notification zone so that way you get notified every time we release a new video like this that's gonna allow you to take your investing game to the next level. I'll see you in the next one.